Hi, guys. Welcome to another episode of the Blue Fort Blueprint, where we bring you the latest world of business and finance. I'm again joined by Sayyam and Viraj as always, and today we're going to be talking about a few really interesting topics. The first one is SEBI's directive to mutual funds on conducting a mandatory stress test, especially on the mid and small cap funds because they feel it's overvalued. The second topic we're going to be talking about is Mukesh Ambani's grand celebration for Anant and Radhika Merchant, of course. And the third thing we're going to be talking about is the all-time highs of gold and Bitcoin, and that's something really interesting. So let's get started. I feel what's really interesting is that SEBI has come in a big way and said that they feel mid and small cap spaces are overvalued in the Indian markets right now. And they've issued a directive to all mutual funds to conduct a mandatory stress test where they've defined some certain parameters so that investors can know whether their mid and small cap funds that they've been investing in is in any danger in any way. First of all, what I think is interesting and what I think I want to talk about is, does SEBI have any business getting into this space and telling AMCs how to run their business, or telling telling investors where they should and where they should not invest?
Look, what has happened over the past few years, right? There have been a lot of discrepancies within the workings of an AMC. We have the way Access was working. There are other AMCs which have always been non-compliant and not always investor-driven, right? So SEBI, in the last few years, the way that they have been taking certain decisions, right, including your expense ratios, including this particular decision of stress testing all their mid cap and small cap funds, is a way that the investor has been protected. There should not be a time, let's say 2, 3 months, 4 months, 6 months down the line, that when that bubble or that froth which has been developed, right, when that bursts, and the only people who suffer are the retail investors. So this is particularly a directive for that, which I think is fair.
Yeah, so froth is the word that SEBI used, that there's a buildup of froth in mid caps and small caps. When they came out with this directive, they told AMFI to do something about it. The concern was that it would be a very hard kind of regulation, that they stop taking inflows, anything like that. Fortunately, it wasn't that. It simply just gives some additional disclosures. The kind of liquidity that's there in this mid cap and small cap portfolios that you're holding, the volatility, the beta, basically just additional disclosures to the investors, that how risky are these funds really, and if things go really bad, then what are the potential losses that you're facing. So I think from that perspective, it really helps, and I think it brings the topic or the discussion back to the fact that mid cap and small cap funds have seen the largest inflows in the last few months. People are rushing towards mid caps and small caps, primarily looking at the historical performance. Because if you look at any decent small cap fund, the last 3 year, 5 year CAGR has been around 30% or more, right? And just looking at that, everyone is rushing to put money into mid caps and small caps, and the index has gone up so much. Mid cap, small cap index is up about 60%. The micro cap index is about 90% in 1 year, right? And compare that to Nifty, which is up about 30%. So clearly, things have run up a lot, and in that, people have that recency bias and see that this is done really well. They forget what happened in 2018, what happened in 2010, 11, 12, where the small cap index actually fell 50% over a 3-4 year period. And I would urge anyone looking to invest in small caps that whatever the performance you look at today, pick your favorite small cap fund and look at what happened in 2018, look at what happened in 2011, 12 before you invest any further large amounts in those funds.
The main problem with relying on historical returns or relying on CAGR is that it's only a point-to-point return. Somebody who invested 5 years ago and who would have sold today, right? But the thing is, you are putting in your money now. So what will happen from now onwards is what you should be concerned with, right? So investing on the basis of CAGR, for example, if the CAGR of a small cap fund is showing 25%, that does not mean that the fund has been consistently growing at 25% for the last 5 years. It's very, very possible that for 4 years it was completely flat, and only in the last year it suddenly went 5 times. That is also
This
possible.
is exactly what has happened, right?
Right.
Even before, let's say 1 year ago at this particular date, the CAGRs of these funds, the 3 year return, the 5 year return, were always in the range of 15, 18, 20%. Right now, as we speak, right, most of the funds, look at all small cap funds, HSBC, ITI, Mirai, doesn't matter which one, right? Everyone, minimum 20% and upwards of 35, 40, 45%. So what SEBI has done is brilliant in a way that you have to be directed. These guys have to know, okay, what is happening with this particular fund. So in fact, the Nippons and the HDFCs of the world, wherein they're managing 50,000 crores in a small cap and a mid cap fund, that's not normal. Yeah, there is no liquidity. It's not possible. For what Nippon small cap fund has 205 stocks. The SEBI mandated small cap the universe is around 250 stocks, right? So how does this work, right? The AMCs, when something adverse happens, it will be very new for the AMC also, which is why yesterday, if you know Mrs. Booch, right, the SEBI chairman, what she's given a direction to them by 15th, after 15th March, they have to publish the results of the stress tests, right? So, and they have to test this on 3x average trading volumes. So if Nippon is at 50,000 crores, imagine the level of stress test they have to go through right now. So if you see the recent corrections in the mid caps and the small caps, is because all of these funds, if you look at historically in the last 6 months, just pick up any fund, right? None had more than 5, 6, 7% cash. Everyone was fully invested. So right now they're building that cash. So when the stress test results come, it will be favorable for them.
Yeah, I think one of the in one of the stress tests criteria is a liquidity test,
Right.
where they'll say in how many days can the portfolio be liquidated? Can
Completely.
25% of the portfolio be liquidated, and can 50% of the portfolio be liquidated? So that should be really interesting for investors to see.
Right.
If they are in a fund which can get stuck, because for example, Quant Fund, and we were seeing some of their holdings, yesterday. A lot of the stocks that they've invested in have done well in terms of their momentum, but of course the liquidity is not there, right? And we are all aware. If I just go back to the Franklin debacle, if you remember in COVID, right, where they shut down 6 debt funds. When a crisis strikes, it's usually not the fundamentals that is a problem. There's usually a news, a sentiment, okay, and then people suddenly start selling. And then it becomes a liquidity issue, which really makes things a lot worse. It becomes a vicious cycle. So in Franklin also what had happened was that while the bonds were not of great quality, but they weren't exactly bad bonds. It's not that all of the companies had failed to pay up their coupons and they had
Correct.
failed,
Absolutely.
and the credit had failed. It's just that there was a huge liquidity crisis. Franklin was not able to return the money back for the amount of redemptions that they were coming. So people don't realize this, but actually Franklin did a brilliant job in stopping those redemptions, because nobody lost money. Not one investor lost a single paisa. But had they done a stress sell at that point in time and given all the money back, then people would have maybe sat on a loss of 40%, 50%, right? So that is really important to understand the difference between fundamentally bad security versus a liquidity crisis that is happening, and that usually happens, I think.
I also want to remind everyone that while this has been started by the mutual fund regulator, that is AMFI, it's as much applicable to anything related to equities, right? So PMSs, there are a lot of PMSs which specialize in mid caps and small caps. That's something people need to be wary about. Again, going back to 2018 when the small cap crash happened, there was a fund manager that had celebrity status, Porinju, right? And his PMS was holding a lot of very illiquid stocks. And when people went for redemptions, literally they could not sell. The fund could not sell any of the stocks, and he was giving the stocks back instead of actually giving money back. So be watchful in your PMS holdings as well. Also in your direct equity portfolio, whatever stocks you're holding, make sure that you are very conscious of which small caps and micro caps that you have, and make sure that your exposure is limited so that you don't get stuck when the market does possibly fall going forward.
One change I feel SEBI can do and bring in is increase the exit loads of small cap funds. I think that's better for the investor. For example, there are a lot of PMSs which have a 3-year exit load, where in the first year they will have a 3%, second year they'll have a 2%, third year they'll have a 1%. And psychologically speaking, whenever you put an exit load on a fund, the investor is aware that, okay, I can't take this money out for the next 3 years, 4 years. Right. You're not losing liquidity in times of emergency, but at the same time, you're not incentivized to take out your money. So I don't think that all equity funds should have the same exit load of 1%.
But the more risky ones.
There's a lot of merit in maybe even having a 3-year or 5-year exit load for some of the smaller cap funds,
So the conversations that I've been having, probably we've all been having lately with clients, is what to do with the small cap funds. If you're holding on to it, if you have an SIP going, what should you be doing with it? Number one, I think if you have an SIP, you can continue with it, because even if the market does correct, if the small cap index does go down, you will still be investing at those lower levels. So as long as you continue the SIP, that is fine. Number two, make sure that your exposure is limited. It's about 10% or so, 10-15%, not more than that. And number three, make sure for your allocation in the small cap funds, the outlook is very long term, for over the next 7-10 year kind of period. Not anything you need in the next few years. You can have a certain amount towards your long term goals, long term retirement portfolio, because small cap fund cycles or small cap index, the cycles are much longer. They go down for about 3 years and again they come up. So have a longer term horizon. In that case, then you should be fine holding.
And I believe any recommendation we give to our clients, especially for with the conversations that we have been having, right, depends on their holding period already for that particular fund. If a client is invested since, let's say, 5 years and above, right, then they don't have to look at it because anyway, their base is very strong. Whatever correction may happen, 20%, 30% is something that they could add on to that, right? The investor that has to be extremely wary is the person who has seen his friends and family make a lot of return in the last 1 year, and now they're coming in the last 2 months, last 3 months, because they are going to bear the most of the brunt of it. Correct. So if you're doing an SIP, it's okay to continue it for the foreseeable future. But if you have invested lump sum recently,
if you've invested a lump sum, I would say that the minimum time horizon required for a small cap now should be 7 years.
absolutely,
It should be 7 years. 5 years is the bare minimum, but 7 years, you should think to yourself that I don't want to take this money out. Because again, like Sayyam said, it's happened back in 2018 where small caps corrected and it took small cap funds, mutual funds, which are professionally managed, 3.5 years just to get back to capital. So if you would have invested in the peak of 2017, it would have taken you 3.5 to 4 years in mutual funds just to get you back to capital. So that is the kind of pain that small caps can give you. So we would say, just in conclusion to this topic, make sure that your portfolio is well balanced. Don't look at CAGRs or historical returns and invest on that basis because those are completely misleading. Go back to your asset allocation, go back to your advisor and say and decide what is the optimal long-term asset allocation for you and long-term mix in terms of large, mid and small cap.
Another thing I want to talk about is the anomaly that we're seeing in the market, where we're seeing two assets that are completely at the opposite ends of the safety spectrum. Gold is seen as a safe haven asset where whenever there's any risk uncertainty, people flock to gold. On the other end is Bitcoin, which is seen as an extremely risky, speculative kind of asset. And both of them are at an all-time high, right? Which logically doesn't make sense. Is there fear? Is there uncertainty? Or is there not? People are investing in both safe and risky assets. While those seem very different, they are also quite similar in a way. They both have value, and the current price of both is reflected by the perceptive value that people have in them. Gold in itself does not have any utility as such. It's not used in industrial usage as much, unlike copper or iron, which has usage in producing and manufacturing. Gold in itself, Warren Buffett famously said that gold doesn't do anything but just sit there and look at you. So people only value gold because of the perception that they have in it, because of the price that the next person is willing to pay for gold. Bitcoin, on the other hand, is also quite speculative. It does not have any underlying asset. It's not like a stock of a company where the underlying company is the investment. It's all purely speculative. And again, it only has value because the next person is willing to pay that price for it.
I do think, though, there's still a fundamental difference of why still gold can be accepted as a safety asset class and Bitcoin still is being accepted as purely speculative. Gold, I think there's a lot of historical significance where when humankind just started their economic activity, they used to use gold as a currency. Now we have fiat currency, of course, but they used to use gold as a currency back then. And gold at the end of the day can be converted into something physical, right? And whenever something physical can be held, there's always some value ki haan, ye cheez meri hai, right? And this belongs to me and this is the weight at which I have this thing, right? So gold, I don't know, maybe it's a psychological thing for me also or for a lot of humans out there, but gold still seems to have a lot of historical significance, whereas Bitcoin, because maybe it's a new technology, it's difficult to accept it in the same way that it's difficult to accept gold.
Any kind of investment you talk about, you have to talk about the investing logic behind that, right? We spoke about the previous podcast, we spoke about equity markets and the logic why they are at an all-time high, right? So if we have to talk about gold and Bitcoin, let's look at gold, right? Whenever we've studied through CFA or wherever you look at it, gold has been a safe haven, as Sayyam pointed out, and it has been a hedge against inflation. Now, if you see in the last 2 years, the interest rates have gone through the roof, especially talking about United States because gold is pegged to the dollar, right? Interest rates have been at an all-time high. The inflation over there has been at an all-time high. So when the dollar falls down, or the gold prices go up, right? Very simply put. And that is what has happened. Because of the inflation, there is a lack of stability within the dollar. And because of that, the gold has increased. And that's the logic which we see. Looking at it in the last 1 year, 15%, 2 years, 25%, 3 years, 44%. And 4 years, 5 years, it's around 100%, which is a CAGR of 7%, which is okay with gold, right? Basically, it's increasing with inflation. And when inflation goes to the roof, your prices will also go to the roof. Looking at Bitcoin, right? There is absolutely no investing logic to that. No matter what charts you see, no matter whatever you you pick up in the last 10 years, 20 years, it's just random, right? So a lot of randomness in the portfolio or in that entire how it's gone up, right? Which I think started during that entire COVID time when there were new coins, new methods of investing in Bitcoins. Again, to my viewers and of course to y'all also, I do not understand the way it works, but I know of people within our circle, within our clients as well, who's made money no matter what you say. So I don't want to be sitting here and ridiculing this entire asset class for no reason.
Gold, like you said, is a hedge against inflation, so it gives you somewhat of consistent returns, especially for Indians, because gold is actually an international asset class. It's priced in the US dollars. So even if gold in the US dollar makes around 3-4%, which I think has been the long-term average in US dollars, because rupee depreciates by 4-5% on an average, for the last 10-20 years. But I think going back to the point, gold and Bitcoin, one more thing about them which is similar, they both have limited supply, because if something does not have limited supply, then it just doesn't work. Right? So that is one more similarity.
Within India also, especially after the introduction of SGBs, right? The investing in gold has become very easy. The liquidity over there has been increasing massively.
Because it's an 8-year lock-in. I don't think I would invest in an SGB right now.
4 to 5% of your portfolio. You've invested in equity, which is an all-time high. We discussed mid caps and small caps and stuff like that. You invest in real estate. I mean, get some rental.
No, forget long-term asset allocation.
But from a gold perspective, right now, if I have to speak about it, what I would do is I would trim down my allocation. If I was historically putting 10-12%, I would say 2-3% right now is still okay. In case you want to do that, no problem, go ahead with that. But do it through an SGB. No gold-based ETF, it doesn't make sense. No physical gold, absolutely doesn't make sense. Your SGBs, you get that additional 2.5%, you get some capital gain exemption, that's good enough.
I would actually agree with Siddhant that right now may not be a great time to be investing in gold after it's gone up so much. Again, I would go back to, I might sound like a broken record here saying that go back and look at history. But again, if you look at 2011 when gold peaked, and whether you look at any gold fund, pick up any gold fund, and you see for the next 8-9 years before COVID, there was barely any return in gold, because when it peaked, the international dollar price peaked at $1,900, and then over the next 3-4 years, it actually consistently came down and fell to $1,000, and that meant that there was no return in gold for about 9 years. And that's what happens when gold shoots up a lot. There is a period of either time correction or price correction, and I think whether we're there already yet, I don't know, but I think we won't see strong, consistent returns going forward as we have in the last 2-3 years in gold.
Like I said, SGB has a lock-in of 8 years, and maybe locking in your money for 8 years in gold in a significant sum. Of course, your permanent asset allocation, whatever you have allotted to gold, that is fine. But from a strategic point of view, would I put a large lump sum in a sovereign gold bond right now? Probably not. I'm more bullish on gold for the next 1 year. But maybe from the perspective of 3 years or 4 years, I'm not as bullish, because I know that interest rates are going to get reduced by the Fed and maybe by RBI as well.
What about on the other end then? What about cryptos? The fact that it's going up so much. People keep asking us what we should be doing with the portfolio. I say you should only have that extent of money there which you're willing to lose 100% of. Bitcoin is obviously a more famous, safer one, but there are others where the price of the coin has just gone to zero, right? So only that extent where you're willing to lose the entire money.
The only cryptocurrency I would invest in, if I would, is Bitcoin.
Correct.
The reason is that because there is some case of end use over there, or some case of intrinsic value, which may not have come to surface right now,
Ethereum also
but
people say,
but
maybe.
Still it's possible. There's been this whole talk of decentralized currency, right? Bitcoin can hopefully in the future achieve that status.
Just to conclude it also, right, as an advice, if you have to give to our clients, we would be the last people to ask advice from, because honestly, as I said, we don't have knowledge, right? Bitcoin and Ethereum, as Siddhant pointed out, could have some end use cases and stuff like that. But as very, very point blank, that just that money which you want to lose, it's okay, it can go to zero or it can be 10x, right? That kind of money you can put it out there, but that's no relevant allocation.
So I think the last thing we wanted to talk about was obviously Anand Ambani's big wedding, pre-wedding bash, where they spent a little bit over 1,000 crores, is what I've been hearing.
Right.
But what's really, really interesting to me is why the hell would all of these people who are probably the richest and the most powerful people in the world come to Jamnagar? What interest do they have? Because they're definitely not the kind of people who would come just to hang out
Correct.
with someone. So what is it about Mukesh Ambani and India and Anand Ambani's pre-wedding shoot where the entire world has come to a single place?
Three things you have to break this down into. Rihanna coming to Gujarat. You had Bill Gates, you had Mark Zuckerberg, you had Adani's,
You're Larry Fink from BlackRock. Yeah.
Exactly. So everyone was out there. So this talks about India's soft power, which has been emerging of late, right? When I say of late, it's been since the last 5-6 years where the government and the industrialists, they have been pushing for India's soft power. There is no soft power in throwing a wedding for 1,000 crores. That's okay. That any billionaire in anywhere could do. But Mark Zuckerberg coming here, going to Mandara in a tiger T-shirt, it's a sign of soft power. Your Bill Gates wearing a sherwani. Did you
Yeah.
even think of that 10 years ago? That's not
Right.
possible, right?
That's not possible.
That's a sign of soft power. So things like this, right? The second point, okay, you have to think about it from the Ambani's family point of view. Reliance as a whole, right? They've always spoken about family. When even you talk to the vendors at Reliance, they think they're a part of the family. You talk to the shareholders. My grandfather is a shareholder since the last 30 years. He thinks he's a part of Reliance. I'm not even kidding. He's just so passionate about it. It doesn't matter what holding he has, right? So Ambani has always made sure that he walks around like a family. Think of it from a shareholder's point of view or from a stakeholder's point of view. Now, these big stalwarts, which we just mentioned, are a part of that family now. He's attended their son's pre-wedding, Radhika Merchant's pre-wedding bash and everything. So now these guys are a part of your family, right? That as a Reliance shareholder or a stakeholder, it gives me that feeling. See, I could be a guy in Jamnagar or Maharashtra who has literally 1-2 shares, right? But still, it will give me the feeling that okay, this is something where I have progressed. And third, of course, you have to think of it that this was not just a pre-wedding. When these kind of names are out here, when these kind of people are out here, it was not in the news. But let's say Susan Lee, the Meta CFO, was also there. Right, Zuckerberg showing his T-shirt is fine. That's publicity. Susan Lee, no one cares, right? But the idea is when all of these industrialists and the big names are out there, it's not only they're not just having cake and celebrating a wedding. There's business happening, which is going to be the 1,000 crore, right? Eventually, it's going to be 100th or maybe 1,000th of that particular business, which is going to get generated from this particular meetings. Yeah, so I think 1,000 crores is a very small amount. What he's pulled off right now is, I mean, it should have been more and more promoted. It's that big an event.
India is a country that can exude so much soft power in the world, so much, because we are a concoction, we are a blend of cultures, and the diversity we have, nobody else has. Like the US has given soft, the soft power that US has, we can be 10 times of that. US showed the world pop culture, US showed the world, how to dress, US showed the world their shows or whatever it is, in the popular culture that do. India has so much. India has Bollywood,
Yoga,
India has
meditation.
yoga, our cultures, our food, our traditions, our festivals, there's so much more, and people are fascinated by this. So just if having 1,000 crores party puts India on the limelight, literally just projects us in the entire world, and like you said, all of these guys, the cost of it is absolutely nothing, and I think Ambani's understand this brilliantly.
It was almost like an India exhibition that come see India. And keep in mind, these guys are all people that have already partnered up with Reliance in some way or the other. So BlackRock, Larry Fink came, but there's a JV with Jio for the mutual fund. Bob Iger from Disney, there's that JV that just happened. Facebook has invested in the Jio platforms. A lot of these companies invested in Reliance Retail. So they're all partners. They're already part of the family, as you spoke about. And he's just doing all of this to further strengthen the relationship and make sure that these guys want to be a part of India and keep investing in India.
And it's very simple, right? If I am invited to a wedding and which is of that stature, right? That grand an event, I am obviously, no matter how much of a business relationship you share, you're obviously going to be overwhelmed and have that positive feelings.
No matter how big you are, the principle of reciprocity always exists.
Exactly.
If I do something for you without you asking me, no matter how big you are as a person, you will always feel indebted to me to do something in return.
A couple of months ago, I think 2-3 months ago, Modi ji also mentioned that, do your weddings over here.
He was the only
Don't-
one missing, I think, at the
don't-
party.
Yeah, don't do. He wouldn't come before the elections. It would have been a problem. But anyway, do your weddings here. Throw your, just don't go outside and do all of it. So this man kind of showed it that no matter how much money you have, you can do an extremely big affair over here if you want it.
what was another power move in my opinion was not doing this at like in Udaipur at one of the fancy palaces or in Jodhpur or somewhere, but doing it in Jamnagar in his hometown and calling everyone there, putting Jamnagar on the map essentially. I think that was a really smart thing to do.
Alright, guys, so thank you so much for watching. As always, I would request you to please like, share, and subscribe with your friends. Please do comment down below to tell us what topics you feel we should talk about and how the podcast is going. Let us know your thoughts. Thank you so much.